US stocks are down on a lack of trade deal progress ahead of tomorrow's key FOMC meeting, where the Fed is expected to hold. The US trade deficit blows out on import stockpiling ahead of Trump's tariffs. The UK signs a trade deal with India, and China's consumers spend strongly over a holiday weekend. That's coming up in our 5 Things in 5 Minutes on Wednesday, May the 7th. And then in part 1 of a deep dive into Australia's $4 trillion pension fund pool, ANZ senior rate strategist Jack Chambers explains a long-term structural change in Australia's previous reliance on foreign capital.
Australia's mandated domestic savings is structurally changing the way the balance of payments looks.
But first, in 5 and 5 with ANZ, the S&P 500 is down 0.6% and the Nasdaq is down 0.7% by 4 a.m. Sydney Melbourne time, with markets still waiting for a Trump trade deal and in a holding pattern ahead of tomorrow's Fed decision, which is expected to be a hold. Here's ANZ economist Bunsi Madhavani in London this morning, previewing that decision by the Federal Open Markets Committee, the FOMC.
The economic setup ahead of the FOMC's meeting this week points to a pause in the policy rate. We are looking at labour market being strong in April, with non-farm payroll data showing strong jobs addition and a steady unemployment rate. The ISM data also showed that the services sector held up despite the uncertainty of tariffs. Both tariffs and inflation uncertainty currently remains high. So what does the Fed do in such a scenario? We think the Fed will be patient.
As of 4 a.m. Sydney Melbourne time, the 10-year US Treasury yield was down 2 basis points at 4.32%, and gold was up 3% at $3,423 an ounce. The US dollar index is down 0.5%, which means the Aussie is up 0.3% at 64.92 US cents, and the Kiwi is up 0.5%, just over 60 cents at 60.02 US cents. West Texas Intermediate futures are up 3.5%, bouncing back at $59.17 US a barrel. Number 2. Ahead of the Fed's decision, the focus was on US trade data for March, which showed a blowout to a goods trade deficit for the month of $163.5 billion as importers scrambled to get shipments over the border before Trump's tariff announcements on April the 2nd. Here's Bunsi.
So what the data are telling us is that ahead of the Liberation Day tariff announcements, consumers and businesses have front-loaded their demand. That corroborates with the first quarter GDP data that we saw, which showed a contraction of 0.3%. But the thing to note is that front-loading demand may continue to drive imports for the next month or two, but it cannot last forever. So the import trends should settle somewhat as we get more clarity on the final tariff structure.
Number 3. The UK signed a trade agreement with India overnight. Here's Bunsi from London again.
Look, the full details of the FTA are not yet available, but what we know so far is that the UK has secured lower tariffs for its exports, such as whiskey, gin, cosmetics, medical device, and cars to India. And in turn, the UK government announced that tariffs on clothing, footwear, and food products will be liberalized. Now, the UK government is expecting the deal to increase bilateral trade by £25 billion in the long run.
Number 4. ANZ's China economists keep a close eye on high-frequency consumer spending data, and they've noticed strong growth in travel, hospitality and appliance spending over the just-completed Labor Day holiday weekend. ANZ senior China strategist Zhao Pengxing says the government there is using a range of ways to stimulate local spending ahead of the tariff shock.
We expect domestic consumption can offset export slowdown partially, not 100%. But what's important is not the numbers, but the policy effort made by the authority, which suggests that China is trying to adopt a more sustainable growth model driven by domestic demand. We believe China has sufficient tools in the toolbox, such as canceling or relaxing purchase restrictions of property and car in top-tier cities, extending fiscal trade-in program to service consumption, baby bonus, or cash handout to low-income class.
Number 5. However, in Australia, consumer spending volumes were weak in March, as ANZ economist Aaron Luke reports.
Nationally, it was a bit worrying to see declines in nearly all services categories. So I'm talking about things like hospitality, health, transport, and recreation. This is actually the first time ABS released quarterly household spending volumes, so spending adjusted for inflation. So Q1 household spending volumes, as well as last week's retail trade volumes, were both flat. So that kind of suggests that consumption recovery has lost some momentum.
Aaron Luke there. Now, in part one of our deep dive into Australia's $4 trillion compulsory private pension system, where 11.5% of everyone's wages are put into a pension fund, ANZ senior rate strategist Jack Chambers explains how that fund is driving long-term structural change in Australia's previous reliance on foreign capital.
It's in the 5 largest private savings or private pension funds schemes in the world, which is quite remarkable considering Australia is nowhere near the 5 most populous countries or even developed countries in the world. And it's been growing very quickly. The RBA estimates that over the next decade, superannuation assets will double again to about $8 trillion. So we're getting to very large shares of the domestic economy. The assets of the superannuation sector will eventually surpass those of the banking sector in Australia. So it's very large relative to the size of the economy. And the domestic savings pool is growing very rapidly as a consequence.
And so where is all this money invested? I'm guessing it can't all go into Australia because it's just too big.
Well, that's exactly it. If pension funds or super funds only invested in ASX-listed equities and fixed income in Australia, they would own basically the entire market, which is not feasible or not prudent. One of the consequences of having a defined contribution scheme, as well as Australia still having a relatively young population because of migration flows, especially compared to, say, Western Europe, where you've had a much more rapid aging in the population, means that super funds, they don't have to manage for long-term liabilities. A UK pension fund has to think about they pay out X dollars to someone in 30 years' time. So historically, they've been buying a lot of fixed income, things that give them a fixed return in 30 years' time. Super funds don't have to deal with that problem as much. So they tend to be overweight equities. They still have some fixed income, but less so than other pension systems around the world. So they buy a lot of equities. And increasingly what they're doing is buying offshore assets, buying offshore equities, a bit of fixed income, but also some real assets, infrastructure, private equity, and things like that. So around 30% of super fund assets are in offshore equities. And we think that'll keep growing just as a consequence of super funds are growing more quickly than the investment opportunities in Australia. So they'll have to increasingly go offshore to find assets.
And so what is the baseline before these pension funds do their thing in terms of Australia's current account deficit and its net international investment position? And how are those funds, changing those situations?
Yeah, it's a fascinating topic. I mean, this has been an area of great economic debate and contention at times around Australia that historically, we had run a large current account deficit, which essentially means Australia consumed more than it could produce, so it had to borrow from the rest of the world. Australia tended to borrow more money from the rest of the world than it lent to the rest of the world. For more people invested money in Australia than Australia lent to offshore assets. What's changing is because we have superannuation funds and a growing private domestic savings pool, more investment can be either funded locally, so you have less need to call on the rest of the world to fund spending and consumption in Australia, but also because super funds are going offshore, there's more investment. You see outbound investment. So one of the ways where that's really clear is that because the superannuation funds buying offshore equities, Australia now owns more equities internationally than international investors own Australian equities. So essentially, we're lending more money via equities to the rest of the world than we're borrowing. That's different for debt. More offshore investors own more Australian debt than Australian investors own international debt. So Australia still borrows on a net basis from the rest of the world. But that is gradually changing because of the domestic savings story. And we expect that to keep going. That is a long-term secular trend that Australia's mandated domestic savings is structurally changing the way the balance of payments looks.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 7th. Catch you tomorrow with part 2 of that deep dive with Jack, and look out for the results from New Zealand's jobs figures today, where ANZ Research expects a rise in the unemployment rate to 5.3% from 5.1% and 0.1% jobs growth. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.